Living off passive income is absolutely possible. Let's get that out of the way right now. But the version of passive income that gets sold online, the one where you set up a few assets, walk away, and spend the next 40 years sipping cocktails while money magically lands in your bank account, is mostly fiction. The internet loves simple stories. Buy this, invest in that, automate everything, escape the system. But real financial independence doesn't look like that. It's slower, it's messier. And if you misunderstand the math or the psychology behind it, passive income can quietly become a financial trap rather than a source of freedom. In this video, we're going to dismantle the fantasy and rebuild something realistic. We'll break down the math behind living without a paycheck, the hidden risks nobody advertises, and the psychological challenges that hit people after they reach their goal. Because building this wrong doesn't just cost you money, it costs you options. And before we get into spreadsheets and withdrawal rates, here's a strange truth most people don't expect. Some of the most financially independent people you'll ever meet are also the most anxious spenders. I've seen people with millions in assets hesitate over a $5 coffee. That fear doesn't come from lack of money. It comes from misunderstanding how fragile passive income can feel when it's your only safety net. So let's start with the basics. Living off passive income simply means your assets generate enough money to cover your expenses without you trading time for wages. That's it. No alarm clock dependency, no paycheck panic. Your money does the heavy lifting. There are two main ways people do this. The first is the cash flow model. This is what most people imagine when they hear passive income. Rent checks, dividends, royalties, money that shows up regularly while the underlying asset stays intact. The second is the total return model, where you live by slowly selling portions of your investments over time. Instead of relying on income, you rely on growth plus disciplined withdrawals. Most online debates argue endlessly about which one is better. In reality, the people who actually succeed usually use some version of both. Now let's talk about the math behind the promise of never working again. The math behind never working again. If you've spent any time in the financial independence world, you've heard of the 4% rule. It's one of the most famous and most misunderstood ideas in personal finance. The basic idea is this. If you invest in a diversified portfolio of stocks and bonds, historical data suggests you could withdraw 4% of your portfolio in the first year, adjust that amount for inflation each year after, and have a high probability of not running out of money for at least 30 years. The inverse of 4% is 25. That's where the famous rule of thumb comes from. You need roughly 25 times your annual expenses invested. Spend $40,000 a year, you need about $1 million. Spend $80,000 a year, you need about $2 million. Simple, clean, dangerous. Because here's what rarely gets emphasized. The 4% rule is not a guarantee. It's a probability based on historical U.S. market data during a very specific period of economic growth. More recent research has shown that in environments with high stock valuations and low bond yields, conditions we've seen repeatedly, a 4% withdrawal rate may be too aggressive. Some analysts suggest safer ranges closer to 3.3% or 3.5%. That difference sounds tiny until you do the math. If you need $40,000 per year and can only safely withdraw 3.5%, you don't need $1 million. You need closer to $1.15 million. That's an extra $150,000 of capital just to maintain the exact same lifestyle. And here's the part that trips people up emotionally. This isn't passive income in the traditional sense. You're not living off interest. You're selling pieces of your assets and trusting that what remains grows faster than what you spend. That leads us straight into the inflation problem. Inflation, the silent income killer. People often say, if I have $1 million, I can take out $40,000 forever. That statement ignores inflation entirely. Money loses purchasing power over time. Even modest inflation compounds aggressively. At just 3% inflation, $40,000 today needs to become roughly $72,000 in 20 years just to buy the same groceries, pay the same bills, and live the same life. If your passive income is fixed, say from bonds or a non-inflation adjusted annuity, you're effectively taking a pay cut every single year. You may feel safe early on, but decades later, you could be financially cornered without realizing how it happened. This is why stocks play such a central role in retirement planning. Historically, equities have outpaced inflation over long periods. They're volatile, yes, but they're one of the few tools that protect purchasing power. If you rely entirely on fixed income, safety in year 1 can turn into scarcity by year 15. So, what's the correct approach? You build a margin of safety. You don't plan for best-case scenarios, you plan for boring ones. You assume lower returns, unexpected inflation, and market downturns, and you keep flexibility. Being able to temporarily reduce spending during bad market years is more powerful than having a slightly larger portfolio. Flexibility is an asset most spreadsheets ignore. Now let's talk about the alternative everyone thinks is safer: the cash flow trap. Many people reject the idea of selling assets. They want income that shows up automatically: rent checks, dividends, royalties, money that never touches the principal. On paper, this feels safer, tangible, comforting, and that feeling is exactly why people underestimate the cost by about 50%. The biggest mistake in the cash flow world is confusing revenue with income. Let's use real estate as an example. Someone buys a duplex that rents for $2,000 per month. They proudly declare they're earning $24,000 a year in passive income. They're not. That's gross revenue. From that, you subtract property taxes, insurance, maintenance, vacancies, management fees, repairs, and long-term capital expenses like roofs and plumbing. After everything, that $2,000 might become $600, and that's before income tax. To replace a $40,000 salary with true net rental income, you don't need 1 or 2 properties. You might need 10 or more units owned outright. At that point, you're not living passively. You're running a business. Real estate can scale, but it is rarely hands-off unless you pay professionals to manage it. And when you do that, returns shrink further. There's also a psychological trick happening here. People undervalue their own labor. If you spend hours managing tenants, coordinating repairs, or researching high-yield investments, you are working, even if no one hands you a paycheck. Many landlords eventually realize they traded one boss for 20 tenants. True passivity almost always comes with lower returns in exchange for simplicity. The smarter approach is to treat cash flow as a stabilizer, not the engine. Most successful financially independent people use a hybrid model: growth assets for long-term sustainability, cash flow to reduce stress. Maybe rental income covers groceries and utilities. That way, during market crashes, you can avoid selling investments at a loss to survive. You don't need cash flow to cover everything. You need it to buy peace of mind. Now let's talk about the most powerful lever in this entire system:
the variable that matters more than returns. Most people obsess over earning an extra 1% on their investments. That's fine, but cutting expenses by 1% often delivers double the impact. Why? Because every dollar you spend requires $25 of invested capital to support it indefinitely under a 4% rule. That $15 subscription, it requires $375 in assets. That $500 car payment, it requires roughly $150,000 invested just to sustain it forever. Luxury doesn't just cost money, it costs years of freedom. One useful metric is the passive FI ratio, your passive income divided by your expenses. If you spend $40,000 and generate $10,000 passively, you're 25% free. The interesting thing is that freedom isn't linear. The first 20 to 30% changes your psychology dramatically. Once your basic survival is covered, risk tolerance shifts. You can choose work instead of clinging to it. This is where lifestyle creep becomes the real enemy. People hit financial milestones and immediately raise their standards: bigger homes, better cars, more expensive habits. The finish line moves forward every time. If spending rises with income, Freedom never arrives. The people who succeed decide what enough looks like and defend it aggressively. Now let's talk about the risk that destroys even perfect plans. Sequence of returns risk, the silent killer. Sequence of returns risk means the order of returns matters more than the average. If the market crashes early in retirement while you're withdrawing money, you can permanently cripple your portfolio, even if long-term averages look fine. A bad first few years can ruin decades of planning. This is why people fail, not because the math was wrong, but because the timing was cruel. The defense is simple but uncomfortable: cash buffers. Keeping 1 to 3 years of expenses in cash or short-term bonds allows you to avoid selling assets during crashes. Yes, it slightly lowers long-term returns, but it buys survival. Insurance isn't about maximizing returns, it's about preventing catastrophe. Finally, let's talk about the problem nobody advertises: the boredom crisis. Many people reach financial independence and quietly fall apart. Work provides structure, identity, and challenge. Remove it without replacement, and people spiral. Humans aren't designed for endless leisure. We're problem solvers. Without problems, we invent them. The most successful people don't retire from work. They retire to autonomy. They shift to optional work, creative projects, consulting, teaching, building things they care about. This is why the real goal of passive income isn't doing nothing, it's control. The healthiest version of financial independence combines a guaranteed baseline with meaningful activity. Design the life first, then build the portfolio. If you don't need to escape your life, you don't need as much passive income as you think. Final thought: living off passive income isn't about a single number or strategy, it's an ecosystem. Growth assets, cash flow, flexibility, skills, purpose. The most secure people aren't the ones with the biggest portfolios, they're the ones who can adapt. And that adaptability, more than any spreadsheet, is what real freedom looks like.